This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
In a day that is kind of mellow, certainly on the equity side, shares of Amazon definitely standing out. Stock's up about 1.5%, just off its highs of the day. Overnight, the company is saying it will invest as much as $4 billion in Anthropic, bagging basically a crucial partner in its move to become a major player in generative AI. We're talking about Amazon's move to be a major player and maybe offering a vote of confidence in a hot startup, which was created by OpenAI veterans. It all leads back to OpenAI.
Yeah, of course, that's the company behind ChatGPT. It's bagged its own mega investment, $10 billion by Microsoft. That was earlier this year, Carol. With more on Amazon's moves and what it all means with us, we got the individual leading our reporting on this deal. Ed Ludlow, the co-host of Bloomberg Technology in our San Francisco bureau. So Ed, this is all about AWS. Explain how this company helps Amazon in its cloud ambitions.
Yeah, this is not a straightforward story. The easiest way of putting it is that Anthropic, in the same sort of category as OpenAI, is regarded as a leading startup, a leading developer of foundation models or large language models. Large language models are the trained data sets that are the backbone of neural networks, basically a brand of artificial intelligence that basically learns by trial and error, much like a human child does, right? And we've all become familiar with generative AI tools where you input commands and get a response. And that's what Anthropic does. It has a large language model and generative AI tool called Claude that has billions, hundreds of billions of parameters, and it's seen as a leader. So the real question is, like, why is AWS making an investment in it and partnering with it? And there are definitely things that both sides get out of this deal.
Well, let's go into it, because that's what I thought was interesting. And I saw you guys actually caught up with the CEO of AWS, and we'll get into that in just a moment. But I think it's very significant, right, that it's done under the AWS umbrella. Right, this is a unit, as you report, that tends to build its own products rather than buy into them. So play with that, expand that for us.
That's exactly the right observation. So, in the world of technology, we're all asking who the leaders in AI are going to be. As you guys know, Alphabet or Google has developed their own large language models, and they are seen as a leader in this space. Microsoft put a lot of money into OpenAI, as Tim observed, and they are a leader in developing large language models. And there were lots of questions for a while as what is Amazon going to do? It has a long history of work in machine learning and in AI, but not necessarily at the LLM or generative AI scale. To kind of tie it all together, when we talk about the computers behind artificial intelligence, we talk all the time about NVIDIA, right, in the H100, that's a semiconductor. We talk about Microsoft and what they're doing on the software side. AWS is a cloud provider. In other words, if you're a software company, you use AWS's cloud capacity rather than housing literally physical servers in your own office. It's just a space efficient thing. And so a lot of the training that's done for large language models and developing AI is done in the cloud. In other words, you're borrowing someone else's computer capacity rather than having lots of big, loud, energy expensive boxes lying around the office. And this is what ties it together. AWS is basically saying to Anthropic, come to us. We will provide you the brains, the compute to train your next generation of AI. And in return, we get to use that AI and offer it to our cloud customers. They get first dibs. So it's a bit of symbiosis that's going on here.
So can you play that out for us even a little further, Ed? Because I think a lot of people are familiar with generative AI models when they play around with ChatGPT and ask it to plan like a healthy meal for them, for the week, or maybe add items to a grocery list. But how does it work when you're a cloud service provider or a company that's using a cloud service provider? And then how do consumers end up seeing that?
Yeah, so we talked about large language models being the trained data sets, lots of data inputs running in parallel. The next iteration of that is what's called a transformer. So ChatGPT or GPT is a transformer. You can issue a command or a prompt to that and in return get text. If I ask a question, I get an answer back. Or if I say, draw me a picture of a cow in a field eating dandelions, it might give me an image back. Goodness knows why I came up with that example.
It's okay.
What Amazon wants to be is a place where you can build these. It's basically saying, we host the compute anyway. come to our platform and you can build your own large language models. Or what you could do is take the template of somebody else's existing large language model and just use your data with it, make it relevant to you. It's become more of a compute platform than it has been a specific end product. But at the same time, remember the symbiosis I was just talking about. A big sense that I got from the interview of Adam is that Anthropic is a leading maker of generative AI tools. And by getting them to use AWS for their compute, they're also getting first dibs on whatever Anthropic is making. And that is something we confirmed in the interview. AWS can turn around to its cloud customers and say, have you heard of Anthropic? It has a really powerful foundation model that you can have first dibs with because you're a paying AWS customer.
All right, and actually we have a little snippet of that interview with the CEO of AWS, Adam Selipsky, joining Bloomberg Technology on Bloomberg TV on their AI push. Check it out, everybody.
We are fully urgent. We have a strategy that we really love. It is different than some other cloud provider strategies. It's true. We have a strategy of providing absolutely uncompromising security, which I don't think is true for all cloud providers. We have a strategy of providing customers the choices to use whatever's best for their job at hand.
All right, that, of course, is the CEO of AWS earlier on Bloomberg TV and Bloomberg Technology, talking with Ed and Caroline Hyde.
Hey, Ed, I'm wondering if there's any sort of move here when it comes to actually using compute power, because we know these things use a ton of power.
Yes.
And AWS benefits when you use AWS. So are you then, is this a move for AWS to say, okay, use this model, use this tool on AWS, and we are going to be the ones who provide you that service, that power, and you're going to give us more money as a result?
I just want to say, guys, super grateful for you giving us some time to discuss this. It's not straightforward. And to answer your question, the other big piece of news that came out of this is that Anthropic is going to use AWS or Amazon's own semiconductors in training their next generation models. It's not as simple as saying, look, I have a semiconductor in my hand, use it to train models. The real world doesn't work like that. What we're talking about is that Amazon has many data centers around the world. Some of them, literally in the boxes, in the servers, have Amazon's latest cutting edge chip. Many of them don't. And all Amazon is saying is that as part of this agreement, we're going to make sure that the compute that we dedicate to Anthropic is coming out of data centers with that next generation chip. And it's important because basically those chips can crunch a much larger volume of data at much higher speeds. That makes it competitive because there's a cost efficiency, there's an energy efficiency to training the models because they're cost and energy intensive. And it also gives us some evidence that the next stage of this story is to ask, is Amazon going to take on NVIDIA, right? We're obsessed with the H100 GPU. The H100 GPU doesn't get sent out to the mail to customers. It goes into data centers operated by the hyperscalers, not Amazon. We're talking Microsoft, Oracle, and Azure from Microsoft and also Google. So what Amazon can say is like, hey guys, not only are we the leader in cloud computing, but the data centers that we run to support our cloud computing, they now have the best chips, as evidenced by Anthropic deciding to use our technology to train their models. Although, a question I asked Adam and he dodged is, did you just pay Anthropic $4 billion to do this?
Yeah. Great story. We will continue in the future. Ed Ludlow, thank you so much, co-host of Bloomberg Technology.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Comes to a fix, not afraid to fight. You got that right. Said you got that right. Show got that right.
Yeah, she definitely got that right. I mean, when everybody was shying away and this idea of like rates going higher and higher and higher, it's not just higher for longer, it's just higher and higher. Katie Kaminsky definitely caught our attention with a call, I think it was about mid-August or so, when she talked about 6% on the 10-year. So let's get into the trade because we do see that bond sell-off continuing. It's now in its fourth week, that 10-year climbing to 4.5%, 4.53 to be exact, last seen back in 2007. Katie Kaminsky on Zoom from Cambridge, Massachusetts. She is Chief Research Strategist of Alpha Simplex Group. And then we've got our own U.S. interest rate watcher, Ira Jersey. He is Chief U.S. Interest Rate Strategist of Bloomberg Intelligence. He's on the phone in New Jersey. So Ira, let's kick it off with you. First of all, before we get into Katie's call, which was really so smart, it feels like right now, the trade today, let's start there. Coming off of last week, higher for longer, very clear in terms of the trade?
Yeah, well, but that was the move on Thursday, and then you had a little bit of a snapback on Friday. I think two things, going on. People came in Monday after evaluating the Fed last week and said, do we really want to stay long here, just with the idea that if the Fed is going to be on hold through most of 2024 and maybe even beyond, right? There is a note of caution there. Then do you really want to be long rates at these kind of levels when you can just go out and buy 2-year notes? And I think that's one of the reasons why you're seeing the steepening. And the second is, overnight there is this global aspect to what's going on as well, where you've seen most of the selling actually start during European hours, and I think that we can't disentangle the U.S. Treasury market from the rest of the global rates markets. And if Japan is going to unwind or widen the bands yet again on its yield curve control program, plus you have a hawkish Europe coming out there and continuing to worry about things like potential stagflation, then I think that there's just not the appetite to hold risk at this point in the year.
Hey, Katie Kaminsky, come on in here and just give us an update on what your call is and when you expect to see. Well, first of all, do you still expect to see a 10-year Treasury yielding 6%? When do you expect to see it? And how has it felt over the last month as we've seen yields continue to climb?
Yes, that's a really good point, because I think we've been consistently short fixed income throughout the year, and there's been a lot of bond bulls out there who kind of disagreed with us. And more people have really focused on last week really being that point of recognition where people have realized that if we're not going to have cuts anytime soon, and if we're in a situation where inflation is going to be stickier, that long-term cash flows, particularly now where there's plenty of supply of treasuries, are not looking like they're priced correctly. And so I think that makes a case for a disinversion of the curve and for a flatter yield curve. And we're finally starting to see that in the data. And so I think what this last month has really shown is that people are coming around to a realization that higher for longer is going to be a reality, despite the fact that we really had very little action on the actual Fed conversation.
So, Katie, 6% on the 10-year, you're sticking by it? And if so, by when?
Well, I think 6 is a good number. I like the number 6, but so I think I like duration premiums. So I think for us, we don't really have a specific number because we focus on trend signals and where the trends are going. But what's interesting about that is that we would like to see a duration premium in the curve. Whether or not that needs to be that we have cuts at some point, we definitely need to see a premium for taking on long-term risk. And that's something we haven't seen in a long time. So I think every investor is starting to say, aha, right. If inflation's is going to be high for longer, at some point I need to get paid to take on long-term cash flows.
So 6% is possible, right? Because we want to see that duration premium. I'm not trying to pin you down, but it's still possible then on a 10-year or maybe even higher. Would you go?
I think these things are all possible if we continue to have higher inflation and if we continue to have a scenario where people realize that there's an excess supply of treasuries and that people need to be paid to hold long-term cash flows with higher inflation.
It just makes sense. Ira, what are you thinking about kind of where we top out or go from here, especially on the 10-year, longer out, that duration premium that investors, understandably could be demanding when we still have inflation out there?
Well, I think that the inflation point is what people are trying to readjust their thinking about, right? There was a large group of people out there who were thinking that oil prices were going to head back lower to like $40 a barrel, and that you wouldn't have a big fear of inflation expectations going up a whole heck of a lot. And certainly they haven't, right? When you look at things like TIPS break-evens and inflation swaps, neither of those has moved very significantly. So a lot of what is driving this is things like term premium, risk premium, where you have TIPS yields that are going up, so real yields are moving significantly higher. When we go back and we think about the forever history of real yields, they were meaningfully higher prior to the 2000s, and obviously you've had a structural shift now. Will we have trend higher rates in the longer term? Could we get the 6%? It's certainly not out of the question, right? In the 1990s, we were there.
Right.
But I think in order to do that, you do have to get inflation expectations probably up a bit more from where they are. So, I can envision a scenario where if you get up to a 6% nominal yield, you probably need to have 3% inflation more persistent, and the market has to price for that. And, the market is not yet pricing for that. Now, could it? Sure. But I don't think it will. I think a lot of what is going on right now is very technical. It is a readjustment of the central bank outlook, and not only here in the U.S. Like I mentioned before, if you have Europe that is going to continue to be somewhat more hawkish and try to fight a stagflationary environment, then that's going to affect Treasury yields one way or the other, just because you're going to have less demand from overseas.
Hey, Ira, a lot of the conversation today has focused on, why we're seeing these moves in the rates market. So break that down for us exactly. I mean, is it about inflation expectations? Is it about growth expectations? Or like you said, just alluded to, it's something more technical?
It's not about inflation or growth expectations at all. It's about policy expectations, which, at some level are related to growth. But the market is certainly thinking that the no landing scenario is becoming a higher probability than it was not so long ago, and really not much has changed, right? The Fed coming out with new dots saying that they're not going to cut as much in 2024 as they thought, and we thought. Our read on that was that there's a distinct possibility, and we've been saying for a very long time that we didn't think the Fed was going to cut at all in 2024, and that looks more and more likely. But this trade, and one of the reasons I think this is technical, is that I do think that if this was much more about not technical and was about fundamentals, that the curve shift would be much more even. So you'd wind up seeing more of a parallel shift upwards in the curve, where you can have 2-year notes kind of approaching the policy rate a little bit more, and then you'd wind up with 10-year yields maybe here too, but you'd see 2-year yields a little bit higher as well. And because you're not seeing that, I do think it's people maybe who were thinking in long duration just stopping themselves out.
Katie, I saw you nodding several times here.
I agree, but one thing I would point out is the technicals have actually already been in this trade. We've been short the position for quite a while. So the people who are changing position are those that have had an aha moment last week. So my view is that the market has had a point of recognition where they said, wait a minute, we actually think that we need to reevaluate the pricing of some of these bonds. Maybe we need to reevaluate the way that we adjust our portfolios. And that is actually causing some adjustments. So we've steadily seen more fundamental investors and different investors adjusting their positions throughout the year, despite the fact that the technical signals have actually been short earlier on.
Right.
And so I think that's an interesting point, is who's trading right now is probably the question. Who's the trader? Who's moving the price right now might be the best question to ask.
Is this a silly question to ask, but I'm going to go for it because when Liz Kaplan-McCormick and Chris Ansey write about it, I go for it. And they basically looked into negative rates returning to the U.S. in a few years. And they cite a Boston College professor and financial historian. And basically, he looked at data back to 1311, and it shows a clear declining trend for inflation-adjusted or real interest rates with bouts of volatility above and below the trend line. Katie, just got 30 seconds. Is it too early to start thinking about this concept of maybe negative rates? We've never lived through a pandemic before, so we really don't know how it ends.
I think we have to be suspect of certain rate periods in history because they rhyme but don't always repeat. I'm more concerned about inflation being back higher for longer, because I think low rates, like negative rates, is actually more of a rare occurrence in history than most. We all think it's normal, but actually a historian would think it's abnormal.
Ira, saved you 10 seconds. Quick thoughts on that?
Yeah, I don't think we're going back. We're going to have negative rates in the U.S. I think the 45-year downtrend in rates is over and broken, and that we're going to wind up seeing rates, more like here as the midpoint of a long-term.
Well, Liz and Chris are going to call you both. I know they're going to continue this discussion. Katie Kaminsky over at Alpha Simplex Group, and of course our own Bloomberg Intelligence, Ira Jersey. Thank you both.
You're for listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Western firms, in fact, in China are now the gloomiest that they've been about the future in decades, largely due to geopolitical risks. This is according to a recent survey by the American Chamber of Commerce in Shanghai. Persistent tensions with the West, coupled with China's economic slowdown, have sparked a $188 billion exodus from Chinese stocks and bonds from a December 2021 peak through the end of June this year, so diminishing the market's clout in global portfolios. We've been talking about it for over a year, if not even longer, about the kind of change in investor sentiment.
The region, though, it's not a monolith. And here with some thoughts on investment opportunities in Asia is John Withar, head of Asia Special Situations for Pictet Asset Management. It's based in Singapore, but we got John with us right now in our Bloomberg Interactive Brokers studio. John, good to have you with us. How are you?
Thank you very much for having me.
All right, let's start with China, and then we got plenty of areas to go from there. But to Carol's point, is China uninvestable now?
I don't think China's uninvestable, but there's certainly challenges. I mean, we're all aware of what's happening with the macro environment there. We're all aware of the property market woes, and the property market is clearly a huge part of the economy. But it's worth mentioning that it's still a relatively cheap market. We're still around about 10 times forward PE. So we're starting from a pretty low base here. I think one thing that we haven't seen yet in China is a policy response, an effective policy response. And I think whilst we sort of sit back and wait and the hope of that sort of starts to dissipate, the reality is at some point, there is a likelihood that there's be some kind of a policy response coming down the pipe at some point. So I think it's not all totally doom and gloom. We do worry a little bit about what it looks like in the midterm, but I think certainly we can expect some kind of a policy response that may see some short-term sort of optimism come to the market. I mean, as you just pointed out, sentiment is at absolute rock bottom, and people really don't own it anymore.
There's sentiment and then there's fundamentals. John, as you're in from Geneva, right? That's your home base. You're in Singapore, forgive me, in from Singapore. And I'm just curious, as you make the rounds here in the U.S. and elsewhere, what are you hearing about investor interest, institutional investor interest, in terms of putting money in China specifically before we broaden out?
Sure. It's not great. Let's be clear. I think people are very, very cognizant of the risks. And there are risks, right? Obviously, the macro is one, the geopolitical is another. And the reality is that we are seeing a bit of a step change now. There is definitely a trend of friendshoring and reshoring out of China that really doesn't help the whole fundamental story as well. So people are very, very switched on about what's happening in China at the moment, and that has obviously really moderated investor sentiment. So it's about as bad as I've seen it in my career, and I've been doing this for many years. But we'll see what happens.
Is it a sea shift, or it's a big change that may not change?
You know what? It's been a gradual decline, to be honest. So, when I was here sort of 3-6 months ago, it was still pretty bad. We've obviously seen some major US investors move a lot of allocations out of China, and a number of the big pension funds have actually said, they're excluding China altogether. So, this is something that it's not a surprise. It's been happening over a long period of time, and we were just waiting for that catalyst to reverse if at all we see it.
It's funny. I was preparing for this interview and got an email from the folks over at LPL Financial with a new note asking the question, is India the new China? And it's a question I thought to myself, you know what? That'd be a good question to ask John Withar instead of me.
Sure.
Is it?
Look, yes and no is the answer. I mean, the reality is, yes, they're the largest population plant in the world. I'd say in the world now, but ultimately, we still need a lot to happen in India for it to realise the potential that we've been waiting for it to realise. They still don't have the infrastructure that they have in China, and the reality is, as an investable market, China is very developed. It's obviously the second largest market in the world. Whilst the Indian population is very large, the economy is nowhere near as large, and the market is still very small and quite illiquid. It's also expensive and quite complex to trade. So the trajectory is great. I think the woes that we saw with Adani and a lot of the attention that we saw come out of that was very positive, because it shined a light on shareholder rights and whatnot, and those kinds of things. But ultimately,
positive in terms of transparency.
Absolutely. So we are seeing the discussions being had where previously you didn't, and that's very important. So in a twisted type of way, it was actually quite a good thing that this happened, because it did shine a light on corporate governance and those kinds of things. But ultimately, that market is still small. And it's still quite difficult to trade. Access is sort of is not ideal, and it's illiquid, and now actually it's expensive as well. So I don't think people are that's barreling in. There's obviously some allocation that's coming into India from other parts of the region. Obviously, as capital does flow out of China, and it's looking to sort of dissipate elsewhere in Asia, it does find its way into India. But certainly, it's something that we think is still very much a work in progress.
John, you shared notes with our producer Paul Brennan, and it was about the macro environment in U.S., China, and Europe are still challenging. This is, again, your guys' view. Asia is better positioned than most regions going forward. Demographic tailwinds will support GDP growth in the region. So basically, you're saying what? In terms of global investors looking around the world, that it makes more sense to invest in Asia versus some of these developed markets like U.S. and China. You made the case for China, but U.S. and Europe even?
Look, I think for us, and certainly for my group, and we're investing in special situations, I think, for us the focus is Japan, which we consider part of Asia. Certainly we do, and that's
Nikkei is up 25%, 10% in dollar terms this year.
Absolutely. And there are a number of reasons, and we can get into that in a second if you like. But that's one part of I think the bull case that we have in Asia. But the other is the foreign direct investment that is flowing out of China is finding its way into other parts of Asia, particularly Southeast Asia. So some of it's finding its way into India, obviously, but you're getting foreign direct investment flowing into markets like Vietnam, Indonesia, Malaysia, Thailand. These kinds of markets are benefiting, and we're seeing that very tangibly. And so alongside what you're seeing happen in Japan and the capital that's coming out of China, that capital is moving into places that are ultimately small, but they are reforming themselves. So
is it all going into other Asian markets or no?
I think it's going to a lot of different places. But as from the statistics that we've seen, Southeast Asia has absolutely been a beneficiary.
Hey, John, you have a really interesting job because it encompasses a very large portion of the world with a very large number of people. Give us an idea of your process in terms of how much time you're spending on the ground in these countries, and how you're getting your data beyond the numbers that we all get with FDI and whatnot.
Sure. So, there are a lot of company meetings. We are meeting corporates. We are trying to get a sense of, what companies are thinking, strategic direction, industries, those kinds of things. And that's very important. Sentiment as well. Corporate board sentiment is really a big driver of our universe. We are going on the ground, but ultimately, thanks to great systems like yours, the information is getting a lot better. And for us, we've got a lot of different areas that we're getting information from. We're sucking it in. We are using data tools as well, using things like natural language processing tools, those kinds of things to suck data in and then give us a better sort of lie of the land in those types of markets.
So if an investor had some new money to put to work in Asia, where would you guys suggest they do? We just have about 30 seconds.
Sure. Unequivocally, Japan. Japan is the market right now that we're most excited about in our space.
All Japan, large cap Japan, specific sectors in Japan?
All Japan, I think, is exciting to us. Large cap's obviously more liquid, but Japan, there's a lot happening. And, we're seeing this 33-year high, but there's a lot behind that. And what drives that ultimately, it's not just the flow of money, it's structural as well. So structural change, corporate governance, these kinds of things.
What would you say, just in 30 seconds, somebody who pushes back and says, what about demographic concerns in Japan?
I think demographics has been what we've been told over a number of years, but the reality is that the structural shifts in technology, efficiency, all these things to a certain extent offset what we're seeing in the demographics. Companies are getting more efficient, they require less labor, all these kinds of things. So we're excited. There's a lot happening. 33-year high. Let's go.
All right. John Whithar, thank you so much. Head of Asian Special Situations for Pictet Asset Management, as he reminded us, based in Singapore, but making his way to the U.S. and joining us here in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Let's get back to what's going on in terms of consumers. A survey from the Federal Reserve last year finding that nearly 70% of consumers are using some sort of mobile payment service or device to send or receive money, and more than 80%, Tim, of consumers using a digital wallet or fintech payment app, including more than 70% of those who are aged 55 and older. I have to say the pandemic was a real game changer, certainly for us as a family. Nobody carries cash anymore.
It's true, but you still do need cash in some situations. Trust me, you do. You never want to find yourself without cash, because I do all the time. And then I'm like, I got to go to an ATM, especially at the bagel store. Yes. Great to have John Kaplan with us, CEO at the publicly traded payment platform Payoneer. It's a company that specializes in cross-border payments. They've got a market cap of about $2.2 billion. John, good to have you with us. How are you?
I'm terrific. It's great to be here.
Hey, it's great to have you with us. Hey, I just wanted to start, before we get into what exactly you guys are seeing at Payoneer, what you're doing, what you've been doing since March when you became CEO of the company. Before that, you were co-CEO. Give us a read on the economy, not just here in the U.S., but what you're seeing around the world.
Yeah, so we are, as you know, Payoneer is a platform that makes it easy for entrepreneurs all over the globe to do business anywhere. Right. And we have customers in 190 countries. So our sense of the global economy is really, on point, because we have millions of customers in just about every region and country on the planet. And what we see is entrepreneurs are very focused on cross-border trade. Small business owners are looking to export their goods and services abroad, and they're looking to leverage the cost benefits of sourcing either personnel to work for them or raw materials for their factory, also across border. So as in some ways, the world has gotten smaller for small businesses, and they are very focused on leveraging the global landscape.
That kind of makes sense. Like, we know what they want to do, but what are they seeing on the ground in terms of customers in different regions? What can you tell us about softness in certain areas of the globe? Like, what can you tell us that, given the data that you have?
Yeah, so we recently completed a survey, Payoneer's inaugural SMB Ambitions Barometer, and 72% of surveyed businesses agreed that expanding overseas leads to increased revenue. However, only 41% of these businesses are currently seizing that opportunity. And so I think inside your question about their confidence in the economy is this goal for diversification, right? Really, small business owners around the globe are looking to find new channels to sell and more places to source. And my supposition coming out of that is to say, you know what, there is some weakness in parts of the economy, and people are looking abroad. In markets like India, where we're very strong, the GDP is growing 7%. In Latin America, we're seeing nearly triple-digit growth in parts of our business because businesses in the West are increasingly using software engineers in Argentina and other parts of the global economy. So it really depends what business you're in and what region you're in, how you're handling the tumult in the global economy.
Well, looking at the DES page on the Bloomberg in terms of your company, I mean, the bulk of the revenue, right, is outside the United States. I think Greater China is second, and then you have the United States. So can you give us some broad strokes on where the growth is? Because it sounds like it's a lot of stuff outside the United States.
Yeah, so our business is about a third China, which is growing very strong, and we're excited about the growth we're seeing in China. A third Latin America, APAC, and CEMEA. Those markets are seeing 45% year-over-year growth, really powering the growth of the Payoneer platform. And as our services have expanded, more invoicing capability, more commercial credit card capability for our customers, we're seeing those customers have more of their accounts receivable on the Payoneer platform. We really are the solution for an emerging market business that wants to do business cross-border.
Go back to China. You said China growing very strong, which is interesting because we just had a guest talking about investment opportunities. This was the head of Asian Special Situations for Pictet Asset Management, John Whithar, and he talked about a lot of investment money flowing out of China. Based on what you're seeing, though, John, what does it tell you about the Chinese economy?
Yeah, so our customers are small business exporters in China. So they're exporting iPhone cases, and they're exporting what are effectively consumer goods that people in the West, have a voracious appetite for. They're not exporting, they're exporters. So they're small business manufacturers. It's different than people who are looking to invest in the real estate sector, for example, in China. That I wouldn't have any color to add on.
I was just curious if there was any kind of business to consumer, though, specifically staying within the China network, if you were the China loop. But it sounds like it's all exporters.
Yeah, our customers are 100% exporters in China. Manufacturers, traders, goods suppliers, Amazon sellers, eBay sellers, Walmart sellers. The people who are, going into holiday 2023 should have a strong season.
What are your U.S. customers? How would you describe them?
So our U.S. customers primarily are businesses in the United States that have contractors or employees outside of the United States and use the Payoneer platform to pay them, to pay suppliers that they have in Asia, to pay freelance software developers in Latin America or Ukraine.
John, I just want to jump in. I think for a lot of people, they don't necessarily know why it's so difficult to do these cross-border payments. I mean, for example, a friend came, I've talked about this before, but a friend came to a concert from the UK and he wanted to pay me back for the ticket. And he couldn't pay me on Venmo. He couldn't pay me on PayPal. And we just decided, the next time you come to the US, you can just pay
cash.
me. Yeah. Like, it's so hard to do this.
Why is that? The real reason for this is if you're a business owner outside of the United States, you don't have a social security number. So you can't get a U.S. bank account. You can't participate in the U.S. financial system as easily as you or I or we can, and have all of our lives. So when you have, businesses abroad use the Payoneer platform to manage their international accounts receivable and accounts payable. So in the event that your friend had a business and was on the Payoneer platform, you very easily could have paid them just as easily as you could have Venmoed someone or made a Zelle payment to someone with the Payoneer platform that's baked into exactly how we've set up the program.
Very interesting. John, come back soon. Love to continue this conversation. John Kaplan, CEO at Payoneer, joining us in New York City. Pretty cool stuff.
Yeah, my friend did pay me back. He was good for it. Don't worry.
Did he send you like a check?
I think he comes
buy
to
you a couple,
US
buy you
a
a meal.
Yeah, I mean, we also tagged along on his honeymoon after he got married. So.
This is where you start to think like Bitcoin or blockchain. Maybe this could be easier, right?
I mean, I'm waiting.
Cross-border, I don't know. All right, you're listening and watching Bloomberg Business Week on Bloomberg Radio.
Shut it off, buddy, now I shut you down.
Yeah, I'm not sure if the choice had that in mind.
I was just going to say that.
House Republicans barreling toward another government shutdown at the end of the month. In case you're not keeping track, this would be the 11th shutdown since 1980.
Well, as in the past, the logic of shutting down the federal government is clear. The Republican instigators believe that the public will rally behind them and force Democrats to moderate Republicans to slash spending, enacting the cuts that they have conspicuously failed to achieve through ordinary channels. Here's the thing, Carol. The record of shutdowns...
It's not how it plays out.
It's not. Well, the record of shutdowns and bringing about the outcome that they want is 0 for 10. Mm-hmm. So writes Josh Green, national correspondent for Bloomberg Businessweek. In the remarks section in the current issue of Bloomberg Businessweek, it's available on newsstands, on the Bloomberg terminal, and at Bloomberg.com/Businessweek. Josh, also the author of the #1 New York Times bestseller, Devil's Bargain, Steve Bannon, Donald Trump, and the Storming of the Presidency. Josh joins us on the phone from Washington, D.C. Also with us is Joel Weber. He's the editor of Bloomberg Businessweek. He's with us right now in the Bloomberg Interactive Brokers studio. 0 for 10. Joel, could be 0 for 11.
Well, I think Josh has written about many of those, right? Like every time it comes up, it's
do you have to go all the way back to 1980?
Where's my Josh Green bat phone? So yeah, there's a couple in there that he hasn't probably written about, but there's a commonality that Josh wrote about here, and as it's unfolding, it's worth bringing that back up. Josh, did I miss that, or have you actually written about all of them at some point?
No, I wasn't old enough to write about the shutdown in 1980, but I do know from my lengthy research that it didn't work out very well, and neither did the next one or the next one or the next one, or probably not the one that we're likely to have at the end of the month. The fact is, these things just don't work, and yet both parties, but especially Republicans, often manage to talk themselves into believing that this time will be different, this time they will work. And there's enough of a segment of Republicans that are believing that right now that I think it's pretty likely that we're going to get the 11th shutdown at the end of this month, barring some kind of last-minute miracle.
Okay, so where are we now, and what are you watching?
Well, where we are right now is that there's a rump group of maybe 24 hardline conservative MAGA Republicans who think that if they shut down the government and just refuse to pass a spending bill, that the American people will rise up and anger at Democrats and somehow force them to cut spending that Republicans haven't been able to win through the ordinary political process. So it's a sort of a immaculate conception spending cut. Nobody has to vote for it. They just have to kind of shut down the government, point a finger, and people will come rushing to their defense. And there have been a number of Republicans, some of whom I quote in this Businessweek piece, essentially saying that, we're going to shut down the government. Ralph Norman of South Carolina said, we believe in what we're doing and the jury will be the country. The problem, if you look at the historical record, is that Americans don't like government shutdowns. They don't like it when they can't get their passport. They don't like it if they work for the government and they're furloughed and don't get a paycheck. They don't like it if their public services are disrupted. They get angry. They go and look at who's to blame, and they find out in this case and in the last case, it's the Republicans. And sooner or later, the party that shuts down the government winds up having a black eye and having to kind of relent, and often, or in fact, almost always doing so without having won anything except for a big drop in their poll numbers.
So, Josh, okay, why do they do it then? I mean, if they come on,
Carol,
if you look at history,
we're talking about Washington here.
I know, but I mean, isn't there anybody who says, "Okay, guys, it hasn't worked for either party. Why do we do this?"
It's actually a really good question, and I went to some length just to kind of break through my ordinary Washington cynicism and made some reporting calls. There are some interesting reasons. They're not going to change the outcome, but one of the reasons is that a lot of Republicans in Congress are new. They haven't been around for more than 2 years or more than 4 years, so they haven't lived through a shutdown. They've never experienced firsthand kind of stepping on the landmine and having it blow up in their face. So they're a little innocent. They've convinced themselves, you know what, people are going to be on my side. They're going to like this. I think the other reason is that a lot of these members live in deeply red districts and just don't bump into people, ordinary independents or Democrats who might have a different view than they do. And so, if everybody and talk to in your political life is a right-wing MAGA Republican, it may seem like a good idea to shut down the government. And they'll just have to discover through trial and error that maybe it's not the best way to kind of get things going. And then the biggest reason of all, I think, is that Donald Trump is the guy who sets the tone for the Republican Party. And Trump came out on Truth Social, his Twitter knockoff social media site, the other day and said, shut down the government. Do not give up until you've got everything you demanded. That is just a fantasy way for politics work. It's not going to happen. But a lot of Republicans do take their marching orders from Trump. Trump obviously has a lot of fans in the party that put pressure on their elected members. And so it very much looks like we're going to have a shutdown and go through this process now, I guess, for the 11th time since 1980. And if there's one thing we know, it's that all of this kind of chaos and pressure is going to blow back on Republicans, lead to a lot of recriminations, and eventually a political loss.
Okay, but sure, there's been 10, 11 of these, but the first for Kevin McCarthy as Speaker, right? So how is he attempting to navigate any of this, and what insights do you have about what options he might have?
Well, the problem and the reason this shutdown is so likely is because McCarthy is a very weak speaker. He only has a 4-vote majority in the House of Representatives. And he seems to be more intent on maintaining his job, maintaining his speakership, than he is on keeping the government open. And so McCarthy is between a rock and a hard place. If he were to go to Democrats right now and say, guys, my right-wing flank is crazy, let's team up with some kind of a moderate spending bill that can pass the House, pass the Senate, and keep the government open, what would very likely happen is that one of these Republicans would file what's called a motion motion to dismiss, which is essentially a vote on whether McCarthy should be fired or not. So he doesn't want to risk doing that. So instead of going and cutting a moderate deal, instead what he's tried and failed so far to do is appease those hardliners. The first thing he tried to do was launch an impeachment inquiry of Joe Biden. He thought that would win him some goodwill. It did not. He's tried to introduce a spending bill that cuts government agencies by about 8%, which is far more than anything Senate Republicans and Democrats would agree to. That didn't fly. Now there's some talk maybe we pass a new bill with a 27% spending cut. That hasn't worked either. So basically there's nothing that's going to make his right flank happy, and therefore in order to preserve his job, he's got to just go ahead with the shutdown prove his loyalty to them, and hope that the pain becomes so much for everybody that they grudgingly relent and allow him to cut some kind of a deal to open the government back up without costing him his job.
Is this just how it goes? Or if there was a different Speaker of the House and it wasn't Kevin McCarthy, do you think we'd be having this conversation and the threat of another shutdown?
I really think we would. The party is just so split between its MAGA flank, which is sizable, and its kind of moderate governing flank, which is less sizable. There's just a rift in the party that can't be solved. I mean, Republicans from deep red districts, by and large, just don't have any interest in compromise anymore. And if enough of them refuse to compromise, what we wind up with is a government shutdown. I don't know that any speaker would have the power to sweet talk the caucus or the conference that McCarthy has into agreeing on one spending bill absent something like a shutdown coming first. And so, as a result, a shutdown is probably what we're going to get.
So if we do get that shutdown, Josh, what ends up being the damage to the Republican Party as we head into an election year?
Well, there's a couple of things. I mean, number one, the Republican hardliners who engineered the shutdown are very likely to lose because they'll be cut out of discussions. At some point, the pressure will become too great. There will likely be a bill that emerges in the Senate between moderate Republicans and Democrats that gets forced down the Republicans' throat. So the hardliners are going to lose. I think the Republican Party overall is going to lose also because this is a black eye when it comes to public relations. In a moment when Joe Biden is really struggling in the polls and Democrats are worrying, can he get reelected? We're about to have a grand display of Republican chaos and dysfunction, which is going to remind voters, well, I may not like Joe Biden. I may not like the prices at the grocery store and at the gas pump. But Jesus, I don't know if I want to sign up for this circus again. And the other problem I think it's going to have is that it's just going to lead to more kind of chaos and dysfunction in Washington, which is going to turn off even more people to the presidential race, to the political system, lead to more bad feelings. And, that's never good for the country and our civic fabric if everybody is angry and despises the people in Washington and the president. And all this is being egged on by Donald Trump and other conservative provocateurs. And so we're going right back into this cycle. We all know how it's going to end, but for whatever reason, Republicans don't seem to be able to kind of pull up the nose of the plane and prevent the spiral that we're all heading in right now.
Okay, so from just like a normal American point of view, like how is this actually going to show up and affect people? Like for that first couple of days, probably not as much, but what becomes the potential costs of this as a shutdown might linger?
A lot of things. From basic stuff like I need to get my passport renewed so I can go on a cruise or on a trip. You can't do it. To I need help from my congressman's office to look into why I'm not getting my Social Security check. That kind of thing. Can't get your call returned. To various agencies being closed. To, if you happen to work for a government agency and are furloughed, you're not going to get a paycheck for a while. The way these things work at the end of the shutdown, eventually, employees will be repaid, but, huge financial disruption to lots of people's lives. And these things tend to cascade. Then there's, of course, the cost to taxpayers. Every time that this happens in the markets, it adds to bond prices and, millions and millions of dollars, taxpayer dollars are spent unnecessarily, fixing and paying for a lot of the chaos that this causes. And, ultimately it just undermines faith in the ability of the U.S. government to function. And that's never good for anybody.
Which is why Moody's came out, right, and said the U.S. government shutdown would be negative for rating.
Josh, I hate to be so cynical here. But if this is indeed bad for Republicans, if the government shuts down, what are Democrats telling you about this? What are you hearing from them about this possibility?
What I'm hearing from every single Democrat is that we're going to step back, get out of the way, and let all the blame fall on Republicans. When your enemy is hanging himself, you just give him more rope. And not only Democrats, but most of the Republicans in Washington say privately they know exactly what's going to happen. There's really nothing they can do to stop it because, the group of legislators that is instigating this shutdown just live in in a different part of America. It's deeper red. They have different political pressures. They're more worried about looking like a rhino than they are and looking like somebody who, can't keep the government open. And it's just created a problem where there really isn't a functioning Republican, even though Republicans have a majority in the House of Representatives, there really isn't a functioning Republican majority in the House of Representatives. And so we're going to see what happens when you don't have a functional majority. Everything, the process is going to break down. We're very likely to have a shutdown.
Okay, so how many more stories about the shutdown are you planning on writing for Bloomberg Businessweek, Josh?
Man, depends how many you assign me. I feel like at this point, we ought to just have a bunch of evergreens on the shelf, or we could just be like Groundhog Day, where we keep running the same one over and over. Republicans in chaos, government shuts down, poll numbers drop, voters angry. I mean, we can just keep updating that every day. It looks like to me.
And then we're back.
The real question is going to be how long does this last? Right? When Democrats shut down the government a few years ago over immigration measures, they lasted all of 3 days and then they kind of lost their nerve. I mean, my sense this time with Republicans is this is going to last a lot longer than that. Maybe as long as the 2019 shutdown, which was 35 days. That was the record for a U.S. government shutdown. You hope it doesn't last that long, but at this point, the system is so broken and so polarized, the Republican Party is, that there just isn't a clear resolution at this point. It's about how much pain and public relations pressure can they endure before they relent, and somebody cobbles together a deal with Democrats. And nobody wants to step forward, certainly not Kevin McCarthy, and be the guy that does that.
The broken. And what's crazy is we're talking
on
about
that happy note. Yeah.
But it's amazing we're talking about the process, right, rather than the substance of what they might be deciding that goes into it. Josh Green, always appreciate. National correspondent for Bloomberg Businessweek, and of course the editor of Businessweek, Joel Weber.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 17 and a half minutes left in today's trading session. We're up, we're down. It's like a little Katy Perry song today.
Choppy was how Denise
Choppy.
and Bill Maloney just described it.
Yeah.
It's totally what it is.
Yeah, it's just, and it's not tremendous big moves, and continue to watch that Treasury trade because it seems like that's where we need to be focused. That 10-year note right now, 454, 2-year note with a yield of 512. So let's get to it. Let's do the drive to the close.
Yeah, we got Greg Halter, Director of Research at the Registered Investment Advisor, Carnegie Investment Council, joining us on Zoom from Cleveland, Ohio. Good to have you with us, Greg. Just start off by giving us an idea of what you're watching, what you're seeing right now, and then we can get more into your views on inflation and what we're seeing with the labor market too.
Sure, and thank you for having me again on the program. Definitely lots of media attention around the potential government shutdown. We've seen this spike in energy prices for the food and especially beverage and chocolate companies, rises in sugar and cocoa. On the other hand, things like lumber have come way down. And of course, we always have economic releases coming this week. The PCE might be the biggest one for the week.
What would you trade on right now? What are the data points? What are the trend lines that you feel confident enough to trade on?
Well, our focus is really on the long term. We look to take advantage.
But sometimes really smart short-term decisions lead to longer-term payoff. So help me out here.
This is true. And you're exactly right. You do get big moves in stocks based on some of these moves. We had some of the real estate investment trusts drop last week on W.P. Carey's announcement and others. And maybe that's an opportunity on a short-term basis. We're not very good at catching falling knives, but we certainly pay attention. And if the fundamentals are not dramatically different, then that is something that we could be attracted to.
Is the S&P 500 a falling knife right now?
I don't think so at all.
What do you think we're going to have lower to go? I mean, we're trading at 43.28 right now, just up 8 points, but still down 4% so far this month. More declines ahead?
Correct. The seasonals definitely are playing a factor, I think. We're kind of tracking the playbook where August was down. September's down so far. I think the seasonals do lessen as we move through the end of the year. I know some have called for 4,200 on the S&P. We don't make market predictions on levels, but that's what we've heard and seen is that's a level that some may be looking at.
Hey, Greg, relationships between indices or assets can kind of sometimes help give us an indication of where things are going. When you look at something like the Russell 2000, which measures, of course, small cap performance, we're down more than 10% from the end of July from a recent high there. Small caps can be very interesting and predictive in terms of maybe the U.S. economy and where we go. What does that 10% decline maybe say to you?
Well, there's been a huge amount of interest in the mega caps, certainly, and I think those have really helped hold up the market. There's so many cross currents these days with the algorithmic trading that it's hard to tell what's really going on behind the scenes in terms of the fundamentals. Yes, down 10%. But does that mean that these businesses are really down 10% in terms of revenues or earnings? If anything, they've become more on the value side of things, if you're willing to step in there.
Hey, Greg, where's fixed income playing a role right now in your portfolios? A big theme of the year has been, okay, finally we're starting to see, savers not being punished anymore.
Exactly correct. We have made a big move in our portfolios to go from the 0.3% we were getting in some of the products of the custodians and so forth into money market mutual funds, where we're getting anywhere from 5 to 5.5% on a risk-free basis. So in terms of client portfolios, that's a huge boost to their incomes.
Why money markets instead of, say, the 2-year or the shorter end of the yield curve?
5-year will give you 4.6, yeah.
We're not strictly on money markets per se. I mean, we have looked at our bond portfolio probably from a 2 to 3 year perspective in terms of maturities. We are looking to extend duration when we think the last Fed rate hike is upon us. We don't think it's there yet. But we do have a mix of bonds, individual bonds, and money market funds. Again, money market funds can really change in yield very quickly versus a fixed product for 2, 3, 4, 5 years.
I mean, what do you believe is the biggest risk to the investment environment right now?
My guess is it would be something that comes from left field, the so-called black swan event. Of course, no one ever knows what those are until they happen. If we had the government shutdown last for more than a couple weeks, that would be a problem. If oil continues to go higher, that could be a potential problem as well. Again, a lot of times these things happen and you don't really see them coming.
Is there anything else that, you've listed those events twice at this point throughout the interview, or is there anything else on your horizon that could kind of push us off course here?
Well, the student loan repayments definitely are an issue. So far, the payments have come in better than anticipated or more than anticipated. But what does that do to consumer spending, certainly on the discretionary side and maybe even on the staple side? We've seen some of the food companies even get hurt because there's doubts whether or not they can push price increases through again.
Well, Jefferies downgraded Nike along with a couple other companies, Urban Outfitters and Foot Locker as well today, as a result of a survey that they did, Carol, about people who have student loan payments being uncomfortable about making sure they're making their budget.
I think this is going to be one to watch. I mean, we just talked about, the Fed's survey of household savings and those in the middle class and certainly at the lower end of the income spectrum. I mean, everybody's down from where we were, post-pandemic with all of the government programs that help beef up balance sheets. But it's a very different story, and people don't have the amount of money that they used to be able to spend. Yeah, it's going to impact things. Greg, thank you so much. Greg Halter, Director of Research at the Registered Investment Advisor, Carnegie Investment Council, joining us on Zoom in Cleveland, Ohio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.